As part of your financial planning or part of your tax planning, are you planning on giving any gifts before the end of the year? I've got 3 gifting strategies you need to consider. That and more coming up. My name's Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Do you have a giving strategy? Do you have is gifting part of your overall financial plan, and is it incorporated in your tax planning as well? Well, I hope so, right? It depends on the stage of life that you're in, and depends on your overall finances, of course. But whether you're giving to a charity, whether you're giving to church, whether you're giving to family members, you need to know that gifts from a taxable standpoint, from a tax planning standpoint, need to be made by the end of the year. So you can't, some funding IRAs and some things you've got up until your tax filing deadline to get those done and have them count for that tax year. Not with giving. It's got to be done by the end of the calendar year. So as we're into fall and almost around the corner into the holiday season, what's your giving strategy for the end of the year? What sort of giving options should you consider? Well, fewer and fewer people are itemizing their deductions, and you're not giving in order to get a tax benefit. You're giving because you care about the church, or you care about the charity or cause you're trying to support. But if in funding that cause there is a tax benefit, well, then you should capitalize on that. That's just good stewardship, okay? So you're not giving to get the tax benefit, but you need to be aware of, well, is there a tax benefit that I could receive for making this gift, or what sort of strategy could I employ? And so more and more people are not itemizing their deductions. The standard deduction is just so high that when you add up your donations, your mortgage interest, and your state and local taxes and property taxes with that $10,000 cap on that, many people are not getting to that threshold. For 2023, the standard deduction, married filing jointly, is $27,700. For a single filer, it's $13,850. And so your mortgage interest and your donations, charitable donations, and your state and local taxes need to exceed that. Otherwise, you should just take the standard deduction. Well, depending on how much you give, obviously that's going to influence whether it's better for you to itemize or take the standard deduction. If you are someone that's looking, saying, well, on an ongoing basis, my giving plus my $10,000 state and local tax limit plus the mortgage interest that I have, it's not above that $27,700 threshold. So therefore, it doesn't really make sense. It's, from a tax standpoint, doesn't help me. There's no tax benefit. Well, one strategy you could consider is using a donor-advised fund for your giving. And here's how that works. You open up an investment account, a donor-advised fund investment account, and then normally you would take a couple years worth of donations and put it into this donor-advised fund, contribute it into the donor-advised fund. When you make the donation, the contribution into the donor-advised fund, that's when it counts as a charitable donation on your taxes. That's when it's deductible on your taxes. And therefore, that's why I say you should consider making 2 or 3 years worth of charitable donations all at one time into this donor-advised fund. That's a way of stacking your charitable donations and getting the tax benefit lumped all into one calendar year. And if you're thinking, well, but then I've just given 3 years worth of gifts all at once, isn't that going to disrupt the cash flow for the cause that I care about, or maybe the church? And that would mean they get this big amount in 1 year, and then they get nothing for the next 3. And so you make the donation, the contribution into the donor advised fund, and then you still control when the money's released from the donor advised fund to the church or to the cause you care about. So you could make 3 years worth of donations all in 1 year at one time, so you're able to itemize and get the tax benefit, but you can still release those dollars every single week or every single month or once a quarter, whatever, from that donor advised fund onto the church or the cause you care about. So if if you're from an itemized deduction standpoint, if you've paid off your mortgage or you've got, a low interest rate on your mortgage, so the interest is very little, and you have your state and local and property taxes capped at 10 grand, and you donate 10 grand a year, that's not going to be enough for a married couple to itemize their taxes. Okay, so that call it, just over 20 grand, and the standard deduction is 27.7. So you're not going to itemize. But if you do 3 years worth of charitable contributions, if you have the cash flow to do it all at one time into the donor advised fund, that's 30 grand right there. Plus the state and local and property tax cap of 10 grand, that gets you to 40 grand, plus a little bit of mortgage interest. So 40 grand or 43,000, 45,000, that's going to be enough to itemize in that 1 year. So you'll get that higher deduction that 1 year, and then each of the next 2, you'll get the standard deduction of 27.7 or whatever it floats to at that point. So consider using the donor advised fund as part of your giving strategy. Second giving strategy to consider before the end of the year, and this one parlays right into that donor advised fund if you'd like to, and that is if you have some investments outside of your 401k, IRA, Roth IRA. So if you've got an investment account outside of a retirement or tax sheltered account, so just an individual investment account or a joint investment account, and within that account, you've got some investments that have appreciated in value, meaning if you sold them or when you sell them, there's going to be a capital gain that you're going to have to report on your taxes. Well, if you've got that going on and you're also giving to a 501c3 charity, a church, something like that, out of your cash, well, consider giving some of that appreciated stock, giving some of those shares to the church or to that nonprofit. And because when the church then sells the investment, they don't have to pay tax on it. There is no capital gain. They don't want the stock. They don't want the investment, even if it's performed really well. They want the cash so that they can fund their operation. So you give them the cash. Okay, you get a deduction for whatever the value is, right? So whether it's going in your donor advised fund or directly to them, you get to claim as a deduction or as a charitable donation the total amount, what the value is. Okay, the church then sells it, or you then sell it within the donor advised fund. No tax on that because it's a tax exempt entity, and then the church receives the dollars. And you might think, oh, okay, that makes sense for an investment I don't really want anymore. But what if the investment that's grown in value is one that I really want? I don't want to give it away. I want to continue to hold it. Well, the cash that you were otherwise going to give to the church, what if you use that same cash to buy the shares back? Are you allowed to do that? Yes. So you just gave away, let's just assume Apple stock. You just gave away some shares of Apple stock and because you bought it here and it's now worth a higher amount. Will use your cash to buy back the same amount of Apple shares. And you might say, wait a second, but I'm going to be buying them at this high price, even though I paid this lower price. I know. So you now own the same amount of Apple shares, but your cost basis is much higher. It's up here versus being down here where someday you'd pay capital gains tax. So second giving strategy to consider at the end of the year is to donate appreciated investments, whether that's directly to the church or directly to a charity or into your donor advised fund. And then the final giving strategy actually doesn't help you on your taxes at all, although we get this question a lot. Hey, if I'm giving money to my kids, can I claim that as a deduction? No, they're not a charity. They're not a not-for-profit, even though they might feel like it at times. But we do get this question all the time because as we approach the holiday seasons, people are making cash gifts to kids, family members, grandkids, that sort of thing. And so just being aware, this final giving strategy, being aware of how much you can give someone else without needing to report it on your taxes or have it be taxable to them. That number this year for 2023 is $17,000. That's the annual gift exclusion amount. And so you can give anyone $17,000 or less and it's not taxable. You don't need to report it. You don't need to tell anyone. You can just give it to them. Married couple, that's due to split gifts and whatnot, $34,000. And if you're giving to 2 people, you can each give $17,000 to each of them. So a total of $68,000. And so that's what you're able to give, and through that annual gift tax or annual gift exclusion. So most people don't give anywhere near that, but as we're looking at estate tax laws changing or the estate exemption amount changing, maybe this is the year for you to start a giving strategy and giving to heirs or to family members at or below that limit. So $17,000 for this year, you can give to anyone else without it being taxable or reportable. Okay, so what's your giving strategy? Those are 3 to consider, and again, you got to get it done before the end of the year. Work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K. WiseMoneyShow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.